Welcome to ETF Leaders, powered by New York Stock Exchange. I'm Lara, Crigger, Editor-in-Chief of ETF Trends and ETF Database. And today I'm joined by Johan Grahn, who's the Head of ETF Strategy for Allianz. Welcome.
Thank you so much. It's good to be here.
Thank you for joining me.
Yeah.
So there are a lot of challenges facing investors in the market in 2022. What do you see as some of the biggest ones?
Well, the number one driver of concern right now is inflation, and that's the big one. That's the one that people are now starting to see and feel all the way into your home, right? You have inflation coming through at 8.5%. That print came out this morning. And as you look at that and you think about the purchasing power eroding away from all this hard-earned money that you have, people are starting to change their behaviors, and you're going to see that come through. At the same time, you have the Fed looking at increasing rates. I think that's a given now. We see May, probably 50 basis points, probably another 50 in June. So that's coming, which makes it very hard to think about where you want to place your money. You see that impacting the bond market very, very quickly. It gets priced in. Not so much in the equity market still. So you have a trifecta of issues where you can't really sit on cash because you will lose purchasing power. You're effectively losing 8.5% a year. In the bond market, you see a little bit of trouble because the Fed has really laid out what they're trying to do. And then on the equity side, you have still rich equity valuations. It makes it very hard to figure out where you're going to put your money.
That is a challenge. So how should investors and advisors be navigating this situation? What can they do for their portfolios?
You know, it comes down to like who you're talking to in terms of how much time they have. So the time factor is the critical one. If you're young, you have all the time in the world to invest, you can buy your meme stocks, buy your equities, buy whatever you want. But if you don't have time on your side, which is the case for most people that are nearing retirement in particular, and those that are in retirement, there's no more income coming in outside from what you've already accumulated. So when you see that being eroded away, it becomes really, really difficult. So how do you handle that? Well, it used to be really, really simple. The playbook for many, many years has been move away from equity when you're de-risking, put the money into fixed income, increase that level of income that you get back into your portfolio that you can use to buy bread and cheese and whatever it is that you want to buy. You can't really do that anymore because the rates are so suppressed. And now as you have the trifecta again of rich equity, you have a tough bond market, you can't really put your money in cash. What do you do, to your point? Well, if you don't want to be in cash because you don't want to see the loss of buying power, and if you have a mitigated, shall we call it, view on bond markets, that leaves equity. But if you don't want to invest in equity because you can't take the risk, then you have to get access to that equity in a different way. And there are ways that you can invest in equity, get some of the upside, and then provide some risk mitigation specifically on the downside.
Well, maybe you can tell us a little bit about specifics. So, I know that you have a number of ETFs in the lineup now. Do you have a favorite?
Well, it's funny. It's hard to have a favorite, right?
Right, a little bit like picking your favorite child, right?
Kind of, yeah. We're not going to play that game. And for the lineup itself, it's all risk mitigating strategies, so they're all functioning and working the same way. So you can effectively decide if you want to have a 10% buffer on your downside, or if you want to have a 20% buffer on your downside, if you want to see it over 12 months or over 6 months. So right now you could, for example, buy 6.0 is one of our funds. 6 months of downside risk mitigation, 10% over the next 6 months, about a 6% upside participation if the equities go up. Another one that's really interesting right now is our 20% buffer, gives you 20% of downside risk mitigation, explicit downside risk mitigation. So if the market is down 20% from now, you're still flat against that. You don't lose any money, but you can still at the same time, you give yourself an opportunity to keep pace with inflation if the markets go up. So it's a way to combat the whole issue of cash and bonds right now, and it's those two I would say are some of the most attractive ones. So 6.0 and AZBA.
Sounds like those are strategies that are really well suited for the moment. So thank you so much for your time, Johan. This has been ETF Leaders, powered by New York Stock Exchange. Thank you for watching, and we will see you next time.